Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for January 11th, 2021. Please see our disclaimer for important information. Well, I'd like to welcome everyone to the new year. This is our first Charts of the Week for 2021, and figure we'd start off with a kind of a familiar series of charts as we're keeping up with the pandemic here. You can see in this chart, this is our latest data as of January 6th, and it's showing that resurgence in case volume and deaths following the holiday season. So we're now in that kind of that 14-day window where we're seeing that uptick, and we've got a lot of jurisdictions that are going into renewed lockdowns because of bed capacity issues, et cetera. Thought I'd show this slide. This is also from covidtracking.com, showing case fatality rates as well as deaths as a share of hospitalizations. Obviously, the hospitalization rate is getting a lot of publicity here, but I think, if you look on the chart at the left, it kind of indicates that the fatality rates are really stable, kind of in that 2% range, and actually a little bit below that. And then deaths as a share of hospitalizations has kind of ebbed and flowed a little bit, but it's in that 2% range. On the right hand side, you can see kind of superimposed over the hospitalizations, but the good news is that the rate of deaths as a share of hospitalizations is not increasing. We've shown this chart before, and in different ways and in different views, but this really underscores the issue that we saw kind of at the beginning of the school year, and looking at the demographics and looking at infection rates and in particular deaths as a percent of various cohorts of our population. You can see the younger cohorts, while there's been a noticeable rise in infections in that 5 to 17 year age group, the death rate has been exceptionally low. So obviously this is a virus that doesn't impact the youth very much. You can see that the numbers very predictably and understandably rise considerably as you get into that older age group, especially that over 65 year, where we've had not nearly as many cases as we've seen in the 18 to 49 year age group, but we've seen a tremendous amount of deaths. So you can see the extremely disproportionate number of those deaths have occurred at that age cohort, which at the infection fatality rate of just over 2.2% is obviously noticeably higher than the death rate exhibited amongst the kind of that millennial core age group. We've also heard a lot about vaccines here lately and the rollout and kind of the lumpiness of the rollout, and a lot of criticisms over the pace at which the vaccines are being rolled out. And this I thought was particularly interesting because you can see clearly that it is not a uniform rollout across the country. Some states, particularly like South Dakota, North Dakota, and some West Virginia, and some of the states up in the East Coast, Upper East Coast, Northeast, I guess, have much higher rates of vaccination as a percent of their population. Granted that their aggregate populations are less, but you can see that other states like Mississippi and Alabama are lagging far behind in that regard. And I think this is something that is with the emergence of these new and more highly contagious strains, it's placing a real premium on getting that vaccine rollout done right. And we were clearly at the end of the year far behind where the initial estimates were. And so I think the real risk in not getting better at this vaccine rollout, particularly amongst the kind of the phase 1A and especially the phase 1B, the most at-risk population, is that it will see an increased prevalence of the second strain, and it could delay a lot of the reopenings. It could push back this expectation that by the middle of this year that we're going to kind of be back to normal. It could push it back, 3 to to 5 months is basically a lot of what I'm reading from a lot of the think tanks and CDC reports and people that are well published on this, including Michael Osterholm of the University of Minnesota, who's one of the infectious disease experts in this country right now. Thought we'd take a quick look at a couple of charts related to high frequency data, and we've got basically an airline passenger chart that comes behind this. But as you can see, this chart takes into consideration the holiday season, so predictably you can understand TSA checkpoint data over the month was up considerably over the last week. It was up considerably, and then other things related to travel, even though there were a lot of weight, that's not the word I'm looking for, really a lot of recommendations being put out to have people stay put. There was still a lot more traffic than I think people realize. But so we've had more restaurant activity. We've had daily rates in hotel, but occupancy has been down. And but industrial numbers have been pretty good, and we've got a couple of charts on that coming up later. So as it relates to rail car traffic, which is down, but overall freight is up tremendously, and freight prices are up tremendously. Steel production is up because industrial production is going very strong. We've got a chart on that coming up, and then you get into the labor market, and there are still puts and takes, and we've got a couple of charts on labor as well. But mixed data, predictable jumps in certain categories tied to the holiday season, and we're very eager to see what that data holds for us here in the first quarter of 2021. This is the TSA data, and I thought this was really neat because it plotted against last year, and the big issue here is how we're tracking relative to a year ago, which I think would be kind of akin to seeing how we're doing relative to normal. And obviously we're well below normal. This chart clearly delineates that, but you can see the big spikes on the monthly basis. You can see kind of that larger bump at the end of November that was tied to the Thanksgiving Day holiday, and then clearly another bump here in December, which has had some legs already into the first week of 2021 related to the holiday season. But again, we've got a long way to go before we get back to that normalized level that was exhibited in 2019. Couple of thoughts on labor here. So yeah, I thought it was very interesting to see, what the demographic dislocation was, and it may seem intuitive, but the delta is pretty stark. So you've got the over 65 age cohort, which has been far less impacted by COVID-related job losses than the younger generation. So you've got a lot of millennials and kind of the older Gen Zers that have been most impacted by the layoffs. Either they've been impacted or they know somebody in their household that's been impacted. And you see that basically, if you take the 18 to 49, which is kind of the meat of your boots on the ground kind of labor force, you can see how they've been impacted by the pandemic. And notwithstanding that, you can also see the breakdown by racial demographic as well, and a very disproportionate Hispanic and Asian impact as well. This from Oxford Economics I thought was really interesting because it kind of puts in color coding kind of the incremental recovery that we've had in labor, and a lot of excitement May, June, July, August, September, as we saw those large numbers of recovery. Again, it's basically the case of the law of large numbers, coming off of the bottom. That, as you can see here, we lost 22 million jobs. We've regained essentially all but about 10 million of those back, but we've seen a kind of a clear stall here in the labor market. In fact, December actually lost 24,000 jobs, and we were curious how that number was going to play out because we did think that we'd see a bit of a stall in the economy before we saw maybe, or we foresee some improvement in 2021. But you can clearly see that kind of rolls over ever so slightly there at the end of the year. Some consumer-related items here. This is credit and debit card spending versus a year ago. So this is all indexed. So everything above zero reflects a positive gain year over year. So somewhat predictably here, you've seen a spike in warehouse club spending as people are kind of looking at building stocks for their home because they know they're going to be spending more time in the home. All categories that we clearly saw a lot of deceleration in things like apparel and things like that. So card, debit and credit card spending dropped precipitously in April, and it's picked up. The good news is we're positive relative to a year ago. So we've seen more spending. We've seen I won't call it a healthy consumer, but we've seen more spending at kind of the lower socioeconomic cohorts. A lot of stimulus money has been put to work, although I think it's clear that money is, the first round at least has been spent, and then now we're looking at this second wave of $600 stimulus checks, and the question still persists as we head into the Biden administration inauguration period, whether we're going to see the $2,000 checks now that we know that we're not going to have a divided government. So we'll be on the lookout for that. But I would assume that that's going to be positive for spending, positive for charge card related to activity. A little financial planning tidbit here. I saw this and thought this was very interesting. Majority of Americans did pull money out of their retirement. And what did they use it for? And I think this is kind of an interesting deep dive into where a lot of families and households have been, where they're obviously dealing with the priorities within the pandemic. So money being pulled out of retirement for living expenses, it clearly runs completely counter to the whole notion of why you have a retirement account anyway, is to plan for the future. But it's clear that you have almost 2/3 of Americans that pulled money out, at least in this survey by Kiplinger, to essentially manage basic needs, living expenses, medical bills. You can also see home repairs. I think people realize that they're spending more time in their home. They might as well, do the work that they've been perhaps putting off. Kind of the, your house is your castle kind of mentality. But anyway, you can see those items there. A few economic charts. This is the services indicator. So this represents the majority of the economy here. This is the Institute for Supply Management Services Purchasing Managers Index. And so it's a diffusion index. So everything over 50 represents expansion. Good news is that we've seen consistent numbers that actually have been not just tepid, but very, very strong lately. And that's a good thing. So we see supplier deliveries remaining strong, even though employment's been mixed to kind of not necessarily positive, but we've seen business activity, new orders, and supplier activity remain very strong heading into the new year. So that's definitely a notch on the plus side as we prepare for what we believe is going to be this synchronized expansion here in 2021. Here's the ISM manufacturing number. Again, manufacturing represents a much smaller minority component of our total economy, but it's strong from a sentiment standpoint. It's strong from a kind of a visibility into trade. into investment, and so on and so forth. And what this message is clearly telling us is that manufacturing is really strong, and that's something that we should all feel really good about right now, that we have both services and manufacturing indices trending in the right direction and looking really healthy as we enter the new year, despite some of these curbs in activity related to the pandemic. I mentioned this earlier, and this is basically container shipment pricing. And this is the index of the spot freight rate for the World Container Index. So even though rail traffic has been a little mixed, perhaps over the last month or so, overall container freight, which represents shipbound freight, inland bound freight, basically anything that gets shipped in a container, which counts for a lot of consumer goods, durable goods, etc. Prices are really strong and noticeably stronger than we saw even in the summer, which is indicative of a supply-demand imbalance, which in turn is indicative of positive economic trends with regard to container shipment activity, which I think certainly is yet another signpost, if you will, for a positive backdrop in 2021. Now we'll talk about housing here for a second, which continues to be very strong. And this is data from the American Enterprise Institute, AEI, and their assessment is that we're going to see continued strong prices heading into 2021. Now, that probably is not a huge surprise to folks, especially those that might be here in Central Texas, where there's very little inventory on the market. But you can see this indicator, just from AEI's point of view on a national basis, is suggesting a 12 to 13% price acceleration just in the next few months alone, which I think, on its face, and you'll see in a minute why there is an offset, but on its face, it would seem to run clearly against housing affordability and would be a choke point for mobility and being able to, folks relocating from one area to another, et cetera, et cetera. But good for sellers, probably good for municipalities to the extent that they'll be able to collect those property taxes and other taxing authorities that depend on property tax revenue. But overall, I think a net positive here that we're seeing home price values for the average consumer that is also a homeowner, because for that particular cohort, the value of one's home tends to represent a disproportionate, a high percentage of their overall net worth. Well, here's the offset, and this is a trend that we've been watching clearly for a number of years, and you can see this is the 30-year fixed mortgage rate as reported by Freddie Mac, which is obviously, along with Fannie Mae, one of the several large mortgage purchasers and syndicators of pooled investments backed by mortgages in the country. And so this is a very representative number for national mortgage rates. And you see they continue to go down. So while prices are going up, mortgage rates are going down. I'm not going to say that it's a complete push in terms of of the net impact of these two things on housing affordability, but at least it's helping somewhat offset the impact of higher prices for would-be buyers, especially first-time would-be buyers. Now let's talk about inflation, because that was one of the themes, if you recall, in my outlook for 2021, is something that we clearly expect to begin to play out and kind of rear its head, if you will, later in the year. And already we're seeing expectations move higher. As we exited the year, they're getting a little bit stronger, I think, after the election, and certainly after the Georgia runoff races and the certainty of surrounding what we know is the congressional makeup is going to look like now. And so those inflation expectation numbers are going higher. Now, the left-hand side is the 5-year inflation swap. There's a definition behind that I won't go into, but basically this is just 5-year forward inflation expectations. And this is, and on the right side is another representation of that, but this is using the Fed's preferred inflation break-even rate. So I think they both are trending, in the right direction. In the same direction. Whether or not you believe it's the right direction, but it is getting closer, if not above, the Fed's 2% target. But even still, I think inflation would have to move much higher, maybe closer to 3, before you'd see any shift in expectations for short-term rates increasing anytime soon. However, looking at the Bureau of Economic Analysis, BEA's numbers, they clearly do see that trending in that way that we just described into 2022, and you can see here that this is it represents kind of a consistent increase. Now, this also incorporates Morgan Stanley's research, and they're obviously a large investment bank with a very well-paid and well-funded research department. So this also it represents, I think, what is being viewed now as the consensus view of inflation trending higher on a continuous basis over the next year or so. As a result, we're seeing a movement in the 10-year Treasury yield. This is a very short-term view. Inflation was ticking up a little bit higher after the election. This is kind of looking at December 8th, basically over the last month, but you can clearly see after the Georgia runoff elections, that number has spiked higher because I think there's a greater feeling of increased stimulus, which in turn might create an environment where we have more dollars chasing fewer goods, which is kind of the textbook definition for the origins of inflation. So as a result, you're seeing the expectations for 10-year Treasury rates move higher. Now, this is important in the sense that, as we just saw a few slides ago, that mortgage rates, 30-year fixed mortgage rates, are at historic lows. But for as long as I can remember, those mortgage rates, are typically indexed to some degree to the 10-year Treasury. And as we clearly see here, those yields on the Treasuries are moving higher. So I think this implies that we could see an increase in mortgage rates in the not so distant future. So with the increase in Treasury rates, and understanding that short-term rates are anchored at or near zero and probably will be for quite some time, we're seeing an increase in the slope of the yield curve. That means that long-term rates are moving higher at a much faster rate than short-term rates, and we're clearly seeing that here in the 2-year to 10-year Treasury spread, which continues to move higher and essentially has consistently following the very stark actions taken by the Fed on monetary policy really in the spring as the pandemic was playing out. Even over the last week, and this is my point on following the Georgia Senate runoff races, and the certainty of having I guess a unified government, if you will, under the Democrats, that we saw a shift in longer term rates, steepening that curve just over the last week. And on the left-hand side, you can see how the yield curve has steepened and shifted over the last year. So you could see that, we were just slightly over 1.5% in short-term rates at the end of 2019. Again, this is pre-pandemic with 30-year Treasury rates at 239 and 10-year Treasury rates at almost 2%. Now, obviously, things have changed, but it just before this last move over the last week, you can see that that whole yield curve has shifted down and it's become a little bit steeper. And then on the right-hand side, not to dig into the weeds too much, it's just clear too that investors in this huge rash of liquidity flooding the markets has had a profound impact on high yield and on corporate yields, and their spreads are really tight relative to treasuries, and that's certainly not symptomatic of a downturn type of environment, but rather symptomatic of an environment where the economy is doing well. Here's a commodity chart plotted against the S&P 500. And this is a total return, so you can see that commodities have largely tracked over the last 6 months or so the S&P 500 total return. So commodities have been strong. A lot of this has had to do with a weak dollar and negative real yields, but not entirely. This is something I've shown before, and this plots in that orange as the copper over the gold ratio. This is copper prices divided by gold, and it's plotted against the 10-year Treasury, and you can see that that commodity, again, copper and gold are commodities / precious metals, and it's basically a math equation of commodities over precious metals, if you will. But that number has been trending higher. We saw that on the previous chart, but what's interesting here is the Treasury yield. The 10-year Treasury tends to follow this very closely, as you can see over the last several years, but it's lagged behind. And so the implications of this are, I think somewhat clear that, we would expect to see higher Treasury yields as a result, which, obviously we're seeing from a lot of different areas, inflation, so on and so forth. And this is just one more kind of suggestive indicator that would tend to lead us to think that 10-year Treasury yields are going higher. This is the dollar. This is the Federal Reserve exchange rate data. So this is essentially their dollar index, and it's clear that we had a peak towards the end of 2019. So we were probably apt to have a bit of a reversal in the dollar anyway, but it's just really played out fairly dramatically in 2020, and I think there's probably additional downside in the dollar, but it on a very short-term basis, the dollar might be a little bit oversold. If you look at this chart and plot it against prior corrections, and you can see that that there's a better than zero chance that we're on the eve of some type of little mini correction in the dollar, but still a longer term slight downtick expected. S&P, a lot of people have speculated, well, how does a stock market do given this environment where we've got Democratic president, we've got Democratic controlled House, and we've got this tiebreaker situation that favors the Democrats in the Senate. Well, as you can see that on the second to the right there, where you have a Democratic Congress and president, the average annual S&P performance has been about 9.3%, and there's been 34 occurrences dating back to 1933. And so obviously that's not as high as you see in some of the other split environments. But again, I don't think most institutional investors are less concerned about the impact of the makeup of the government than this chart might suggest they would. But I think I've received enough questions that I wanted to put something in the chart pack this week that would at least give you some perspective on that. S&P 500, this is price to sales. So there are lots of different indicators. There's price to book. There's obviously price to earnings, and we've talked about that a lot. This is price to sales. And as you can see, dating back to 1990, we are as high as we've been. The prior high was at the end of last century when we were in the tech bubble, when you had a lot of technology companies that were at least reporting a lot of sales but weren't profitable. But price to sales here, I mean, we've really punched through that prior high and even what we saw just a couple of years ago in price to sales. But another indicator that we might be ripe for a short-term correction. But I wouldn't make the case that we're massively overvalued. Just err on the side of caution here over the near term. This is the Russell 2000, and it's moving average. It's a 200-day moving average, and again, this would tend to support the notion on the broader, maybe the smaller cap indices. That while I do believe that there's going to be some running room for small caps, I guess perhaps over the near term, they might be stretched from having acted really strong to their trend lines. Again, I'm not a technical investor, but this just shows you that relative to their 200-day moving average, Russell 2000's at a high point. I thought I'd put this chart in just to show, with the election and with the Senate runoff races, that there's this renewed thought that some of these areas that are reflected in the Biden administration's goals have already benefited. We've already seen investment, and this particular chart shows you clean energy and solar relative to the overall index, and those areas have benefited fairly strongly on the rhetoric coming out of Washington. This is a chart that I think is really interesting from my perspective, because I do see more benefit in the international markets than I do in the domestic markets. And even though the valuations in aggregate aren't nearly as attractive as they were, it's still clear that the international markets, and especially emerging markets, are just simply more attractive to me than the U.S. is right now. And this is something else that I noted in my outlook that I think will play out in 2021. And I'd like to finish on cryptocurrencies. I think a lot is going to be written in 2021 on cryptocurrencies. If there's ever a market that seemed to be stretched right now, it's Bitcoin and crypto. You can see the crypto total market cap exceeded $1 trillion. And on the left-hand side is the chart for Bitcoin itself, which continues to defy gravity in ways that I think are it's difficult to explain, but I think in some respects people view Bitcoin as kind of that new gold because of the scarcity of it. Again, it's still a awfully, for all of the press and all the evolution that we've seen in crypto, it's still a fairly non-well-defined market in terms of the regulation, in terms of how it's being viewed. Is it an asset? Is it a currency? And is it a commodity? A lot of those questions have yet to be answered, and I think until they are, you're going to see a lot of volatility, perhaps some short-term trading opportunity in crypto, but not necessarily as a real core store of value. That's all we have for this week. It's good to get going here in 2021. I think it's going to be a good year. And I'm excited about charts of the week and market minutes coming up. I look forward to talking with many of you, fielding your questions, and getting back with you and just having more dialogue in 2021. I hope you have a wonderful and safe week, and look forward to talking to you again soon.